Inside the economic machine, how to read markets like Ray Dalio. Imagine you could look at the economy the same way a doctor reads a heartbeat. You would see every rhythm, every imbalance, and every moment it needs oxygen. That is exactly how billionaire investor Ray Dalio sees the world. He does not view markets as chaos but as a predictable system of cause and effect. If you have ever wondered why markets rise and fall, why the Fed raises rates, or why booms always turn to busts, this episode is for you. Once you understand how the machine works, you will stop reacting emotionally and start thinking like those who profit from it. The machine has three moving parts. At its core, the economy runs on three simple forces: productivity growth, the short-term debt cycle, and the long-term debt cycle. That might sound complex, but it is simple once you break it down. Think of productivity growth as your income and the debt cycles as your credit card scaled up to a national level. When you buy something, your spending becomes someone else's income. That person spends again, creating income for the next person. That is how economic activity moves, millions of transactions creating a continuous flow. Here is the catch. Not all spending comes from income. Some comes from credit, and credit adds fuel to the fire. It lets people buy more today by borrowing from tomorrow. That is where the machine speeds up and eventually overheats. The short-term cycle, the economy's breathing pattern. The short-term debt cycle lasts about 5 to 10 years. It is the rhythm we feel as booms and busts, the economy's way of breathing. When rates are low and credit is easy, people borrow, businesses expand, and asset prices rise. Then comes the exhale. Debt builds up, inflation rises, and central banks step in to cool things down. Rates go up, borrowing slows, and the economy contracts. That contraction feels painful with layoffs, lower profits, and market drops. But it is actually the system resetting itself. A healthy breath out before the next inhale begins. Every crash you have heard of, from the dot-com bubble to the 2008 crisis, was just another exhale in this breathing pattern. Once you understand that rhythm, you stop fearing the downturn. You start preparing for the opportunity it creates. The long-term cycle, the debt snowball. Beneath that short-term breathing lies a slower and deeper rhythm called the long-term debt cycle. It can last 50 to 75 years and shapes entire generations of wealth. It is the process of debt building until the system can barely breathe. It starts innocently. Borrowing fuels progress, governments fund growth, and people buy homes and businesses invest. But over time, debt grows faster than income and cheap money becomes an addiction. Eventually, the burden becomes too heavy. People forget that debt must be repaid or inflated away. When that happens, economies face three choices: austerity, default, or inflation. Austerity slows growth, default breaks trust, and inflation quietly erodes the debt's real value. That is why central banks constantly balance short-term control with long-term survival. As Dalio says, if you understand credit, you understand the economy. Productivity, the real engine of wealth. If debt is the fuel, productivity is the engine. It is the only sustainable source of real wealth. Productivity grows when people innovate and create more output per hour worked. It is why nations that educate, automate, and adapt stay wealthy. You can print money, but you cannot print productivity. When the machine slows, central banks can only buy time, not prosperity. Real wealth comes from doing more with less, not from borrowing to maintain the illusion of progress. When headlines scream about recessions or stimulus, remember they are short-term adjustments. The long game belongs to productivity. Why the Fed matters and why it is always late. You have heard the phrase, "Don't fight the Federal." That is because the Federal Reserve is the machine's control panel. They raise rates to cool inflation and cut rates to boost growth. But the truth is that the Fed is always reacting to data that has already happened. By the time they see the signs, the cycle is already in motion. They are steering a massive ship with a delayed rudder. That is why investors who study the cycle often spot turning points before the Fed does. In 2020, stimulus and zero interest rates fueled one of history's fastest recoveries. But that same policy planted the inflation we faced in 2022. Different year, same machine. The tools change, but the pattern repeats. Understanding that pattern gives you power the headlines never will. How to read the machine in real life. So how do you read the machine yourself? Start by tracking 3 simple signals: credit growth, interest rates, and productivity trends. Together they tell you exactly where the economy stands. When credit expands and rates are low, markets usually rise. When debt levels are high and borrowing costs climb, risk increases. When productivity outpaces debt, wealth compounds safely. Dalio says, "He who lives by the crystal ball will eat shattered glass." Do not predict every move, just recognize the rhythm. Once you do, you will make decisions based on logic, not panic. Inflation, the silent force. Inflation is not evil. It is a sign the machine is running hot. Think of it like printing more concert tickets without adding seats. More money chases the same goods, and prices rise because demand outpaces supply. A little inflation encourages growth, but too much burns purchasing power. Deflation, on the other hand, freezes spending and innovation. That is why central banks aim for around 2% inflation, not too cold and not too hot. When you hear about rate hikes, think of it as the Fed turning down the thermostat. It is not punishment but maintenance. The goal is to keep the system alive and stable. Wealth gaps and the social cycle. Here is the part most people miss: the human side of the machine. As cycles repeat, wealth gaps widen. Those with assets grow wealth faster, while those without struggle as prices rise. Over time, inequality breeds tension. History shows it leads to polarization, protests, and major policy shifts. The 1930s, the 1970s, and even today all tell the same story. Understanding economics is about more than money. It is about empathy and awareness. It reminds us that behind every chart are real people living the consequences. The global machine, interconnected and fragile. Today's world is one big machine connected by trade, data, and capital. A crisis in one region sends shockwaves across continents. A supply chain delay in China can raise prices in New Jersey. Globalization turned national economies into gears in a single system. When one slows, others feel the strain. When one overheats, it can spread inflation worldwide. Investors now need to see multiple machines interacting at once. The US debt cycle affects emerging markets, currencies, and commodities. China's productivity surge reshapes global manufacturing and competition. To think globally is to see the clockwork, not just one gear. Investors who learn that view spot opportunities long before others even notice the movement. How to think like Dalio. Ray Dalio's strength is not prediction but pattern recognition. He does not ask, "What will happen next?" He asks, "What is happening again?" He studies centuries of data to find repeating cycles of debt, inflation, and human behavior. That is how he anticipated the 2008 financial crisis long before most analysts even saw the risk. If you want to think like him, adopt 3 habits. Study past cycles because they rhyme even if they do not repeat. Think in probabilities, not predictions, and remove emotion from decision-making. Dalio says, "Pain plus reflection equals progress." When markets hurt you, do not just react, learn. Every loss teaches a lesson about the machine. What this means for you. You do not need to be a Wall Street expert to use this knowledge. You just need to understand the basic patterns. When the economy expands and credit is cheap, ride the wave but stay disciplined. When inflation spikes and rates rise, focus on cash flow instead of hype. When panic takes over, remember that every contraction plants the seeds of the next expansion. The key is not predicting every twist but surviving every season. Wealth comes from understanding cycles, not chasing trends. Final thought. The economy is not random. It is a living machine powered by human choices. Money, credit, and innovation are its gears. When you understand how it moves, you stop being afraid of it. When the news says the market is crashing, take a breath. Ask yourself where we are in the cycle. Once you see the rhythm, fear fades and strategy takes over. The goal is not to control the machine but to move with it. Once you learn its rhythm, you stop being a passenger and start driving. This is not financial advice. It is financial awareness and the first step toward mastering the patterns that run the world.